Hello and welcome everyone. So today's video is a little bit different from the type of content that you typically see on our channel. In today's video, I am going to talk to you a little bit unplanned, a little bit unscripted, and what we're going to do is cover some of the key questions that we repeatedly get from our clients. And I hope that the answer that we provide will be extremely useful for you and will help you in your wealth creation journey along with Wright. So the first question that I get from our clients is, how is the quant that Wright Research offers differentiated from the number of quant strategies that are available in the market? To answer this question, let me first talk to you what quant investing is. Quant investing is, if you think about it, very similar to traditional investing, right? What a traditional investor does is look at different factors or different numbers in the market and take the decisions based on it. What a quant like me does is we take the philosophy that we think is the best and we put it into a system. What that helps us do is that now that it is in a program, I can start optimizing it, right? I can take it in different scenarios, try to find the best way to participate in different scenarios and try to see how the system can do the best. Second key differentiation, you exactly use AI in investing. See, AI has a very, very important use case in investing. If you are a quantitative investor and you are only looking at previous data, then what is the value that you're adding? When a human tries to invest, they have an idea on what they expect from the future. So forming that expectation in terms of the language of quantitative investing is trying to form forecast. And that is the beauty of quant investing, right? I can use these numbers and try to forecast what happens in the future. Obviously, the forecasts are not 100% accurate, but as researchers, what we do is try to find as robust forecast as possible. And by robustness, what I mean is that you will train this model on some historical data. And what we try to do is make sure that our predictions on the history match the level of accuracy between history and what the model hasn't seen. The forecast that you can do in the financial market can be on anything. So I am a very curious person who has played with financial data, a little too much. But what I would like to tell you here is that forecasting returns in the market is extremely difficult, whereas forecasting risk is much more reliable because risk doesn't change every day. A market continue to be in lower risk market for a while, and then they switch into higher risk market, which also sticks. So we try to use AI in forecasting risk, and we actually do use that in the strategies that we offer. Now, the second use case of AI that I have fallen in love with is trying to extract sentiment and information from the news and the articles that come out. I am sure many of you are aware about Wright Research being part of Google AI Accelerator program. So we do have access to a lot of credits as well as the advanced model that Google provides, and we are using generative AI not to create any sort of content, but to extract information from the research articles and the news articles that we get. So to give an example, what you can do is extract the sentiment. Is the news that came out of about a particular stock positive or not? Second, is there any corporate governance issue that came out? Is there any news about the bankruptcy that came out? Is there a news about any other sort of event that came out from that particular article? And then identify how that influences the stock returns. And that is where we are experimenting a lot with the new age. Now, another question that I've been getting regularly for the past 6 months is that why did you start a PMS and why should I invest into your PMS instead of your advisory? So see, with PMS, I, as an investment manager or a fund manager, get to do all the decision making required in managing the money. With advisory, I never know what the client did with my advice. Did they execute it? Did they apply it? And if they missed it, then I have no control over it. With PMS, we execute every order. We can optimize the execution prices. We can not only give you the best stock selection, but also the best way to actually execute it. And it, in fact, has a lot of benefits. So if you have a large capital that you want to deploy into our strategies, I would say for any capital more than 50 lakh, PMS is an excellent option. Because number one, for large capital, you do have to get good execution in place. You cannot just put it out as a market order into the market, because the market will actually give you a bad price. So with the PMS, we slice and dice the order, we look at timing the orders and trying to apply the limit prices or the execution methods to give you the best execution prices. With PMS, your investment gets a lot more flexibility. With advisory, if we have a model portfolio, then we have to follow a schedule. We have to send the updates on a Monday or the first of the month, because a number of people rely on that calendar. Whereas with PMS, I don't have to actually take permission or give an advice to anybody to execute. I can execute whenever I see an opportunity, or I can execute whenever I see a risk. So that makes my approach much more proactive. And you would typically see that the PMS portfolios will get in terms of when the stocks are entered and exit, because they have a much more proactive element. And number three is just about convenience, right? So when we started Wright Research and when we would go to some of the larger investors, they would not want to do advisory with us, right? They do not want to apply these rebalances by themselves. They want somebody to give them a full end-to-end service. And with PMS, we are giving you an end-to-end service. You don't really need to touch your portfolio ever. You just can have a look at it and see how well it is doing. And there's no need for you to do any action on that portfolio. We'll be taking care of timing, we'll be taking care of when to best deploy it, when to it, and any such concerns that might happen. And obviously, with PMS, because you're putting such a large amount of capital with us, we will be much more available for you. You can just reach out to the investment manager whenever you have any critical questions, and we are there to answer any of your questions. Another question that we get repeatedly from our clients is, how would you react if there is any sudden risk that happens in the market, right? So before I address that, let me talk to you about our expectations from the market. Definitely, we have strong expectations from the current market because of the strong India growth story, the resurgence of the infrastructure segment, as well as India becoming a favorite investors for foreign capital. But nevertheless, we definitely have a number of risk mitigation techniques in the Wright Research portfolios. So I designed these strategies with the basic idea in place that we want to be consistent, right? So our strategies, you would see, are different from many other strategies in the sense I am trying to always maximize risk-adjusted returns and not just returns. Risk is a critical thing at play. So our portfolios are always very diversified. Even in a 10 stock portfolio, we have actually 10 different industries being part of that particular portfolio. So it's extremely diversified. So that reduces the risk. Second is we talk a lot about risk adaptiveness. What that means is that we think that the market will go through a bear phase and a bull phase. In a bull phase, we will be adaptive and taking high risk because the market is giving you the opportunity. But in a bearish market, you will conserve capital if you reduce risk. The moment we see that the market has gone through a bearish regime, we will reduce risk in our strategies and automatically safer stocks start getting allocation. How do you predict that a bearish zone has started? That's also extremely difficult. But what I would like to tell you is that it doesn't happen in one day and it doesn't happen every day. So in our 4.5-year journey, right since I started Wright Research, there have been two very clear such cues. One was before 2020 crisis, and we deallocated in February 2020 itself. Therefore, the correction that the strategy saw in 2020 March was not as high as what the market saw. And second thing is, we again deallocated in 2000 to the macroeconomics as well as the risk scenario hinted at that being the start of a bearish or a risky zone. And we don't go into low risk zone very frequently, but we stick to our choices for the long term when the model says so. And that is what we'll do. Now, despite all of this, we have a layer of deallocation as well, right? The moment we see very sharp correction, let's say a 10% correction in 2 weeks, we do start taking proactive action. What we do is we start deallocating away from the strategy 10% at a time with every 10% correction, right? That even further reduces the risk that you are incurring from the portfolio. and helps you safeguard the capital. Now, along with this, in our PMS portfolio, we are also able to hedge those portfolios. So we have a simple philosophy in place. Whenever we see that the volatility or the VIX levels have crossed certain threshold in the market and a strategy is seeing certain correction, what we'll do is we'll buy put options or go short in the market by a certain and try to safeguard the capital. Now that only acts as an insurance. So there are a number of ways through which we try to mitigate risk in our strategies. And historically, we've communicated that very clearly with our clients and will continue. Another question that I get time and again from our investors is, and people who are talking to different clients get again and again is, how do I choose the portfolios where I should be allocating to? So let me break down how I typically advise the clients to choose any of our portfolios. So the first question that we ask them or try to understand is their stage in life, their risk profile, and what is the percentage of their capital that they're putting with us. So if let's say you are a moderate risk investor and you are going to put a sizable sum of your investment with Wright Research, if you come to our PMS, I would tell you that let's take a certain, let's say a 70% allocation to the factor fund, which is our moderate risk, and a 30% allocation to alpha, so that you have a flavor of high risk investing as well. If you're coming to our small case, what I would tell you is have a look at the balanced multi-factor or the momentum investing to be your moderate allocation, and then allocate something to our alpha or a new India portfolio or the small cap portfolio to get an allocation for thematic and high risk as well. If you are a high risk investor, somebody who's young, who can take a lot of risk, I would tell you that take a higher allocation to our alpha or a higher allocation to, let's say, a new India portfolio, and let that be a major part of your portfolio. Now, if you are a moderate risk investor, but you are not putting all of your money with Wright Research, you just want to get the flavor of, let's say, the best performing strategies, then I would say choose an alpha or a new India and allocate the money that you want to allocate to that. If you are a beginner in investing, I would again suggest that understand what risk means. Risk as a concept is very simple and easy to talk about, but in real life, risk is extremely difficult to manage. You're very happy when your portfolio is giving you a 10% return in a month, and that's how your expectations get built. But the moment you will see a 5% correction, you will become a little bit disoriented. And that is what risk is, right? Risk means that you'll be losing capital. So when I say there's a high risk, high return strategy, it will give you high return, but there might be a time when you will lose some of your capital as well. So only if you're comfortable with that risk, go for our high risk strategies. And like I said, risk management and managing the risk proactively will be a core part of all our strategies. And managing the risk proactively will be core part of all our strategies, be it on PMS or be it on. I think we've covered 5 questions, but let me throw out a bonus question for you that I get asked once in a while, which is how much can I rely on Wright Research? What are your long-term plans? And can I look at you for the long term? So to answer that, I have left a corporate job and started Wright Research 4.5 years ago because this is what I love to do. So we are going to be doing this for the very, very long term. What we want to do is to be able to do what we do at scale, offer our services and our products to as many clients as we can, and do the best for our clients, right? So like I said, on a day-to-day basis, we're talking to a lot of clients and trying to grow our business. But yes, along with it, we're spending a lot of time on the research that we do in the background, trying to find out the better factors, trying to find out better ways to mitigate risk, trying to find out the best way to save cost for our clients, right? And solving those problems is what we are extremely passionate about, and that is what and that is what we want to do successfully for a large scale of clients for the longer term. We have a small and lean team which is well set to be there for the long term in the market, and a long term plan is to contribute the best that we can to stick to our philosophy of good performance consistently. So not just focusing on returns, but only on risk adjusted returns, and giving a consistent performance successfully to the largest set of clients, and to create a difference in a large set of people's lives. So I think we've covered 5 questions, but let me throw out a bonus question for you that I get asked once in a while, which is how much can I rely on Wright Research? What are your long-term plans? And can I look at you for the long term? So to answer that, I have left a corporate job and started Wright Research 4.5 years ago because this is what I love to do. So we are going to be doing this for the very, very long term. What we want to do is to be able to do what we do at scale, offer our services and our products to as many clients as we can, and do the best for our clients, right? So I hope you liked this unscripted and unplanned YouTube video for this week. And I hope I was able to provide some clarity on some of the key questions that our investors always have. If you like this format and if you think there are certain questions that I missed, please write that down into the comment section. And please do like and subscribe if you want us to present more such videos. Thanks a lot for listening to me blabber on. And I'll see you in the next time. Till then, have a great weekend and happy
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget